Good morning and welcome to 5 Before the Bell, TheStreet.com's global market update and U.S. market preview right here. From the central London studios of Core TV in the heart of the financial district, I am Martin Baccardax. I am the London Bureau Chief here at TheStreet.com. I'm going to take you through those 5 things you need to know before the bell. But on a day like today, it's the 5 things you need to know before the Fed decision at 2 p.m. But let's get to what's happening in global and European markets right now, because we did see some cautious optimism, it has to be said, in the trading last night. Record closes again for the 3 benchmarks in the United States, but it didn't really ripple through to what we saw in Asia. We did rise a little bit, and we're hovering at near 10-year highs across the broadest measure of Asia stocks, but there wasn't a great deal of conviction in the trading, and you can understand why, coming ahead of the Fed meeting today, the announcement at 2, and then, of course, the press conference at 2:30. Europe opened up a little bit to the downside, but just started to claw its way into positive territory. Again, no real narrative drive, a decent amount of M&A activity and some joint venture announcements, but nonetheless not enough to really upset the day's narrative. And of course, that is pointed to Washington later this afternoon. The biggest mover, in fact, this morning was the pound. It spiked to near 136 against the US dollar. That's a more than 16-month high, pared back a little bit, and it was rising on the back of better than expected retail sales data for the month of August. Those numbers were delayed owing to a glitch at the Office for National Statistics, but they came out today, and they do show that spending is actually increasing at a much more rapid pace than pretty much anybody imagined. Now, there is a caveat inside there, which I don't think is being discussed in the marketplace. August retail sales numbers are significantly impacted by tourism. Tourism this year has been driven largely because the pound has been so weak. It's lost about 13% against the US dollar in the past 16 months. We can't dissect whether tourists are driving the spending or whether Britons are driving the spending. But nonetheless, it seems to have cemented, at least in most people's minds, that the Bank of England is going to raise interest rates in the coming months owing to faster inflation and, again, underlying strength in the consumer economy. I'm not buying it, but that's not really important because traders are buying it. And as I say, they're pushing up the pound higher. I tell you what people aren't buying as well, and that does seem to be things at Bed Bath & Beyond. The shares are probably going to open 15% to the downside at least an 8-year low at the open of trading today, and they may lurch even further. The company gave us weaker than expected Q2 numbers last night. Earnings per share came in at 67 cents, well shy of the Street's forecast of around 95 cents a share, and they slashed their full-year outlook by around a third to $3 a share. This is just an amazing story coming off the back, of course, of yesterday's Chapter 11 filing from Toys R Us, and just another example of the way that the U.S. retail landscape is changing so rapidly. It was only a few months ago, back in December, that we were looking at Bed Bath & Beyond as an excellent example of the way that you can have a hybrid business model where you keep bricks and mortar stores open and, in fact, keep expanding them, and you are allowing that because you can lure customers into your digital platform by having them go and browse around inside the shops. You browse, you come back, and you buy online. That was seemingly driving the value in this stock for a number of months. It is definitely not the case, because what we're seeing now is like-for-like sales actually fell by 2.6% at the stores that are already opened, and that simply didn't offset the very solid, it has to be said, gain for digital sales. But I was struck by a number that I found this morning doing a bit of digging from the U.S. Census Bureau. In the second quarter of this year, online sales represented just under 9% of total U.S. retail sales. Over that 3-month period, that was $1.2 trillion. The online portion of that was about $112 billion. Here's the thing. They are growing the online sales at a rate that is 4 times faster than regular retail sales. So if you don't have a digital platform in place that can drive sales and earnings growth, you're simply not going to survive in this kind of retail environment. I do believe this is part of the reason that we're looking at such a massive slash in the share price for Bed Bath & Beyond at the start of trading today. And as I say, it's probably going to open at an 8-year low. We're going to watch that one with interest, and you do have to pay particular attention now to the retail space, because it seems that business models that were successful only 7 or 8 months ago are now being torn apart, and those changes are going to continue, and they're going to continue with a rapid pace until we understand exactly how it all shakes out in the retail space. That might not be for another couple of years. These stocks are going to be volatile, and if you are an investor who doesn't like volatility, this is the sort of thing that you may want to step back from, at least in the short term. Moving on to the big merger story that developed last night and seems to be in place again today, and that is the potential tie-up between Sprint and T-Mobile USA. T-Mobile is majority owned by Deutsche Telekom here in Europe. 64%, in fact, is the ownership stake. And yesterday we saw significant gains for Sprint shares. They were up 6.7%, and T-Mobile shares, they were up 5.8%. Now, the story first came from a report from CNBC, and others appear to have, well, if not confirmed it, seem to have spoken to very similar sources, which say that the conversations about tying the two groups together are ongoing, but more advanced than they have been in the past months. Now, you remember there was a potential tie-up between these two back in 2014, and it was kicked to the touchline by regulators under the Obama administration. So I do wonder now if the investment bankers and the investors in the firm think they might get a better hearing from regulators under a Trump administration. That remains to be seen, because ultimately a deal between the number 2 and the number 3 carrier would trim the 4-player space down to 3. And that's not the sort of thing that competitors and competition authorities really like, because, of course, it drives up prices as a result. So from what I'm reading this morning, there's about a 50-50 chance that this could get regulatory approval, if indeed it were even to go through in the further due diligence stages. Now, that would probably mean that we aren't looking at anything into 2018 or potentially beyond by the time the regulatory review is completed. Nonetheless, the shares do seem to be getting some traction. Deutsche Telekom shares, again, the majority owner of T-Mobile with a 64% stake, were up about 3% yesterday, and they rose about 1.2% in Germany today. They were one of the top gainers on the DAX Performance Index. So investors do seem to be pricing some action in as a result of these reports, and they are gaining traction without question. However, you do have to wonder how it's going to be managed. The reports we're reading are that it's going to be an all-share transaction. Those are difficult to execute when you're looking at the different ownership structures. Sprint is largely owned by SoftBank, the Japanese conglomerate that is controlled by the billionaire investor Masayoshi Son. And of course, T-Mobile is controlled by Deutsche Telekom. An all-share deal would be complex, considering the fact that Sprint is laden with an enormous amount of debt, about $12 billion of which comes due in the next 4 years, and because T-Mobile has that 64% holding. Lots of barriers to cross, lots of hurdles to clear, both from the regulatory and the financial perspective, but this story has been gaining some momentum, and I would imagine it's going to do so in the coming days. Come back to TheStreet.com. We're going to have all the coverage from our tech team on this one, because it could be a biggie. Biggest story today, though, without question, is the U.S. Federal Reserve's rate decision at 2 p.m. today in Washington, and the press conference that follows with Chairwoman Janet Yellen at 30 minutes after that. We aren't expecting any change in the base rate from the Fed, and the anticipation is that the best we can hope for is some sort of clue as to whether or not the projections for future rate increases are being priced correctly by financial markets. And that, I know it sounds a bit sort of high-minded, but nonetheless, that's exactly where we're headed. People talk a lot about the balance sheet trimming, and that is important. You'll remember that the Fed has taken on about $4.5 trillion worth of government bonds, mortgage-backed securities, agency bonds, etc., in an effort to lower risk-free interest rates and tease investors into riskier portions of the market that will hopefully ignite investment and increase employment. That's been largely successful. The U.S. economy has grown decent, if not spectacularly, in the 10 years since the financial crisis, and the unemployment rate in the United States is at a 16-year low of 4.4%. The one thing that the Fed hasn't been able to do, though, is stoke inflation. Their preferred measure is sitting at a rate of about 1.4%. That's sharply lower than the 2% target the Fed would like. And the difference between the fact that we have very low unemployment but very low inflation is something that has puzzled central bankers, economists, and everybody else for a number of years. So those are going to be important conversations at the press conference today, as is Chairwoman Yellen's future. Her term is set to expire in February 2018, and there's been all sorts of speculation that she may not stay on, that the president may not ask her to stay on, and that, in fact, there might be a new chairperson coming in as a result of the changes. Now, that would mean there are 4 seats up for grabs on the Fed's Open Market Committee. That would mean a sea change in the anticipation of what direction it would head in, depending on what happens with the selection process and ultimately what happens with the economy. So maybe financial markets simply aren't able to price these anticipations correctly because of the major changes that are happening inside the Fed and the major changes that are happening in the real economy. Every story that we have covered this year for TheStreet.com seems to point to slower inflation, you were talking about artificial intelligence, you were talking about self-driving cars, you were talking about robot technology in the regular employment market. Even today, we're talking about the ways in which consumers are shopping around and paying less and less for more and more goods because they can find cheaper prices. We see the way that shale oil production is lowering crude prices. And even when we have a historic hurricane season, as we've had in the United States, oil prices are still hovering around $50 a barrel. I could go on and on, but you're getting the message. The global economy is changing, and the ways in which we see price increases and the acceleration of consumer inflation is changing along with it. From my perspective, central bankers, which come from a different generation than we do, simply don't understand this and therefore can't put it into their computer modeling. And therefore, I think all of us are mispricing the risks of inflation going forward. I think that's part of the reason why you're seeing 10-year Treasury bonds still trading at around 2.2%, which is a long way away from where they should be if people think that the Fed is going to raise rates in the way that they normally would. They're not going to do that, and some portions of the market have a price correctly, whereas others don't. What I can tell you, though, and I stand by this, inflation is dead in the way that we used to think about it, and that means major changes in the way that we need to think about the Fed and think about interest rate hikes in the future. And moving on to Wall Street, we are looking at a little bit of a gain right now, but nothing worth talking about. Maybe a couple of points to the upside for the Dow Jones Industrial Average. And what I'm seeing from now from U.S. futures is basically a relatively unchanged landscape for the start of the trading day. All is going to change, though, at 2 and then, of course, at 2:30 when Chairwoman Yellen begins to speak. One stock that I didn't mention today, which is probably worth talking about, is FedEx. It's called about 1.4% to the downside. They had worse than expected Q2 earnings last night. This is an interesting one because around $300 million in operating earnings for the quarter were trimmed as a result of a cyber attack on its TNT Express unit here in Europe, in the Netherlands. This is one of the few companies that we've seen itemized the way in which cybersecurity attacks have hit the stock, and therefore we found this one to be curious. Hurricane Harvey has also trimmed some of the earnings potential over that quarter, but not by nearly as much as the cyber attack. So the companies that were implicated in the twin attacks that occurred over the summer are going to be ones to watch as they approach their earnings season, because if FedEx is a barometer, other companies are going to suffer as well. That's it from us here in the heart of the financial district in central London, and 5 before the bell. I'm Martin Baccardax, London Bureau Chief at TheStreet.com. Thanks for watching, guys. Good luck today, and we'll see you tomorrow.